Good afternoon, and welcome to yet another lecture on bonds and how we deal with their valuation. We spend a lot of time focusing on bonds because the relationship between bonds and notes payable is very similar, and that the notes payable concepts are much simpler if it is something such as a basic note. So, a lot of this information you can just translate right over. So, when bonds are issued between interest date, so we have the bond date. This is the beginning of the point according to the contract that interest is beginning to accrue. But something could have happened in the process and the issue occurs thereafter. That point of time between the beginning of the interest and the actual purchase, interest actually accrued. Companies will typically make their bond interest payments as defined in the bond indenture semi-annually. And when an issue in the actual sale of a bond occurs at a date other than the interest date, this creates a bit of a conundrum because the new bondholder has not actually earned that interest that accrued from the beginning, from the bond date to the actual issue date. Um, the terms of the bond indenture are going to state that X percent of Y amount is going to be paid on specific day. Um, and the bondholder will receive that X percent of face value on day Y. So, because they are going to be receiving interest that they're not entitled to because they did not hold the bond from the bond date to the issue date, the bondholder pays basically like an upcharge when they purchase the bond that is equivalent of the interest that has accrued. So that when they receive that actual interest on the interest date, then they are only legitimately receiving um, in excess of what they overpaid the amount that they're supposed to receive. So, to illustrate this, let's look at Taft Corporation, and they're issuing 10-year bonds. Their date is January 1st, 2017, and they have a par value of 800,000. They have an annual interest rate of 6%, payable semi-annually on January 1st and July 1st. So at the point of issuance, they record the bonds at par plus accrued interest because that is how they will sell them. They will sell them with a portion of the interest already attached to it so that when they issue that interest in July at full value, they aren't losing money. They aren't paying more than they have to. So what they will receive is $808,000. This represents 800,000 times 6% times 2 out of 12 because there are 2 months, the full month of January, the full month of February, between the bond date and the issue date. They only have a legal obligation of 800,000 at maturity, so they recognize bonds payable of 800,000. And then they do this offsetting interest expense of 8,000 to represent the amount that will offset the full interest expense posting on July 1st. So on July 1st, this is only 4 months after the date of purchase, they pay the purchasers the full 6 months of interest. Because remember, it's X percent on specific days. So they have an interest expense of 24,000 and they pay out cash of 24. The net effect is 16,000. That is the amount that they needed to pay out in regards to entitlement for 4 months. However, they had to pay out 6 months due to the legal contract. 8,000 of it was prepaid by the bondholders. So when both of the entries, the purchase entry and the first entry for expense, both enter the interest expense, they create that net amount of 16,000. But if they were to have issued the bonds at 102, um, their March entry would be a little bit different because the 800,000 would be subject to 102 and there would be a premium at play. So they have $800,000 worth of bonds, but the premium amount, the amount paid in excess of it, would be 16, and then there would be an additional $8,000 for those 2 months of prepaid interest. So they have cash coming in of $824,000. Now, their interest payment would be the same as the prior slide. On July 1st, 2017. They would pay out the 24,000 in interest expense and they would have the cash. The only difference would be is that they would need to amortize their bond premium accordingly. Now remember there's a couple of ways to amortize your bond premium. This is either with the straight line method or the effective interest rate method. You can use the straight line method if the difference between it and the effective interest rate method is not material, meaning it's not going to impact someone's decision making. The effective interest rate method is the preferred method. Excuse me. Um, and what it does is it creates the periodic interest expense equal to the constant percentage of the carrying value of the bonds. So that's a whole lot of words to make something seem much more complicated than it is. So your effective interest rate is the rate at the time the bonds were issued, not the stated rate, but what the market rate was. Uh, in order to determine these amortization amounts, in reality, what happens is that there is a schedule of bond interest amortization that gets created. And we're going to look at one of those here shortly. It provides for the same total amortization over the term as straight line, but the amounts per period are going to be different. They're not going to be constant because they're going to be based off the changing carrying value of the bonds at the beginning of the period. This utilizes time value of money, and we will demonstrate the problem in the following slides. So the first thing we start with, because for the effective interest method, these are bonds that are issued at premiums or discounts. They're not issued at face value. So we're going to start with a discount. And we go through the calculations that Evermaster Corporation issued $100,000 of 8% term bonds on January 1st, 2017, due on January 1st, 2022, with interest payable each July and January 1st. Investors, so this is what the market was looking for at the point of issue, require an effective interest rate of 10%. So we need to calculate what the bond proceeds would be at that exact point in time. Now, if you think back to the valuation slides, we talk about how the bond proceeds are the present value of the amounts to be received from the obligation. So that is $100,000 that will be received in 2022. And then that is the 8% interest over the course of January 2017 through January 2022. So to start with is that we need to look at what the present value of a single sum due in 5 years at 10% interest semi-annually will be. So we start with the present value of the single sum. Um, on the present value table, we go to present value of a single sum. And I am just really quick pulling up table 6.2. And the second page of it. As you know, these present value tables are a little bit large, so you'll have to uh, forgive me that it's just going to take a minute to get it there. So I'm just going to pop this over here. You see they use 0.61391. As you can see, hopefully, on your screen, here's that 0.61391. Then we're going to look at what the present value of an ordinary annuity is of 4,000 interest payable semi-annually for 5 years at 10%. So 5 years, 2 terms. That's going to be 10 periods. 5% because it's 5% that you'll receive on each for a total APR at 10. So we need to look for the present value of an ordinary annuity because they are regular payments. Oh, wait, these are present value of an annuity due. I apologize. So, and with the annuity due, then we back it off by 1. These are future value, present value. And here we go. Here's the present value of an ordinary annuity. 7.72173. So when we carry that multiplication over to $4,000, we add that to the 61,391, and that gives us proceeds to be expected from the bond issue of $92,251. This means that the discount on the bond, the difference between maturity of value of the bonds payable and the amount that we received, is $7,722. This is the amount that we're going to need to address with the effective interest rate method for amortization over the period of the bonds. So to do that, we engage in creating um, the the bond amortization schedule. We start with a face value. We multiply it by the factor, and that gave us the present value. We took the semi-annual payment, multiplied it by the factor, and that gave us the present value of the interest payments, giving us the total amounts that were received to calculate for amortization necessity. So here's a schedule of a bond discount amortization. Now we start with the carrying value of the bonds on the date of issue here. That's the 92,278. You'll see here in this particular line, we have all of the interest payments over the course of the term. Now, the amount of interest, the cash paid out, is not going to change. That is stated in the bond indenture. This is $100,000 times 8% times 6 out of 12 because there are two interest payments, so we are fractionating. So the 6 out of 12 each time, that's 6 months out of 12, represents the time between interest payments. Now, this is where we start looking at the effective interest rate method. Now, we know that uh, at the point of issue, 10% was what the investors required. So that is the effective interest rate that we will use for the entire term of the bonds. Interest fluctuates up and down over years. We don't change this as we go on. We go with what happened at the point of inception. So these bondholders had a requirement for 10%, which is why we only received 92,278. So we calculate what their expectation of interest would have been, and that is the amount that they gave us. So this is how much was actually borrowed, multiplied by 10%, multiplied by 6 out of 12, because that is the amount of months that we are calculating each time. So in this first period, that expense is 4,614. We are paying out 4,000. That means that $614 of what you could almost look at as our prepaid interest expense obligation in the form of the discount is going to be applied. So this is the amount, the additional amount that would be amortized. That would go to your interest expense, and then we would reduce that from the discount on bonds payable. Therefore, our new carrying amount of the bonds would be $92,892. We fall into the next interest period, payment period. Again, this 4,000 will never change. It is the amount of cash that leaves. We will always have this 4,000 because it is defined in the contract of the bond. So then we need to calculate what the interest expense expectation would be based on the 10%. So we take the 92,892, we multiply that by 10%, and then by 6 divided by 12. That gives us 4,645. That means that the amount that will be amortized is the amount in excess of the 4,000, bringing our new carrying value to 93,532. And then we continue to repeat the same process through the entire life of the bonds. You'll notice that at the point of maturity, the bond carrying value will be $100,000, equal to maturity value and face value. So the journal entry on January 1st, 2017. We have a beginning amount of $94,925. Oh, I'm sorry, January 1st, 2017 is not the correct date because this bond issued January 1st, 2014. So we have a little bit of an issue here in the slides. So we'll fix that just like that. This is bond issue. We received 92,278. We have a discount on bonds payable of $7,722. And then we have a bond payable obligation. So When this issue of bonds runs its course over at 5 years, we will have $100,000 that we need to pay to those that we borrowed it from. Now, to come in and take care of that first payment and the amortization discount on July 1st, 2017, we go through those calculations. Remember, it's the carrying value multiplied by 10% and then the fraction of time to give us 4614. The amount that will be amortized is the amount in excess of what is actually being paid as a result of the bond contract terms. In this case, that amount for amortization is $614. So we have a total interest expense of $4,614, with 614 of it posting to the discount on bonds payable. We're taking into account that amount of interest uh, that essentially we prepaid by not receiving it in proceeds, and the $4,000 in cash that will be paid out to the appropriate bondholders. Continuing to move forward into the next period because our carrying value changed. When we posted the prior entry, which is a credit to the discount on bonds payable, this resulted in the carrying value of our bonds payable increasing. So in the secondary period, we have the 92,892 multiplied by 10% multiplied by 6 divided by 12 gives us an interest expense expectation of 4,645. We'll pay out 4,000 due to the contract terms, and that's the semi-annual payment of 8% on the $100,000. That means that $645 of our discount represents the interest obligation for this specific period. We go ahead and engage in our entry, and these dates still are not right. So now we're looking at, we're still looking at 14. So we have an interest expense of $4,645. We have interest payable of $4,000 and the discount on bonds payable of $645. When we engage in this credit, that then increases the carrying amount of the bonds on the books to $93,537. You will need to understand how to actually make these calculations here, especially if you're going to go into a testing situation. However, as you can see, these would be very easy to calculate for a company in practice using the Excel program. So when bonds are issued at a premium, that's when they sell for more than their face value. The effective interest rate is going to be less than the stated rate. So we start with the maturity value of the bonds. We calculate the present value of what that payment is going to be due in 5 years at 6% because that's our effective interest rate. That gives us the present value factor of 0.74409, so 74,409. Then we calculate the present value of those interest payments. They're still going to be 4,000 because the terms of this bond didn't change. It's 8% of 100,000 semi-annually. And when we use that effective interest rate, so this is what the investors require, that gives us 34,121. This means that we will collect in proceeds from the sale of the bonds $108,000. Therefore, we have collected $8,530 more than our obligation will be of $100,000. Here's just a couple of quick slides showing you the face value, the present value of one, present value of a single sum, and how we found that factor. So 3%, because that is 6 divided by 2 for 10 periods, 0.74409 in 10 periods is 5 years semi-annually, gave us a 74,409. Now, when we look at the present value of an ordinary annuity of 1, we have regular semi-annual payments of 4,000. Then we have 3%, 10 periods, semi-annual, so that's 2 in a year, times 5 is 10. Effective interest rate divided by 2, because there's 2 in a year, is 3. That gives us a factor of 8.53020, and a present value of 34,121. This is how the bond proceeds would have calculated out. So then we engage in creating our schedule bond premium amortization. So when we have a premium, that's an adjunct account, so it's adding to the bond value. We do this very similarly as we do with the discount. 4,000 is what it is. That is defined in the bond indenture. We will pay out 4,000 in cash, regardless of what the effective interest rate expectations were, the needs and demands of the investor for this particular borrowing. We will pay out 4,000. This is our legal contractual obligation semi-annually. So how we start is we start with the carrying amount of the bonds. Same way we did with the other one. And then we multiply that by the 6%. We're looking for our effective interest rate yield. And then by the fraction of time, which is 6 divided by 12, 6 months. That means that there was an interest expense expectation of $3,256. Now, the difference between these is that we are actually paying more than expected. And that difference is in the amount of $744. So we need to remove that from the carrying amount of the bond. So we will debit there and we will credit our interest expense. Moving forward, as we look, we have again, these are not right. They say 17, they should say 14. We have the original proceeds of the bond. So this is the carrying amount of our bonds. That is our bonds payable plus the adjunct account of premium on bonds payable for a total of 108,530. So that's the amount of cash that came in. We post that to premium on bonds payable for the amount in excess of our 5-year obligation, which is our bonds payable of $100,000. When we move forward to deal with the first payment of amortization, again, year 2014, not 17, we have calculated that the expected interest expense is $3,256. So this is an absolute. This is based off the 6%, the carrying amount of the bonds, and the fraction of time, 6 months out of 12. So our interest expense is $3,256. That's a known absolute. What we also know is that we are going to pay out $4,000. We're going to reduce cash by $4,000 in the form of a credit. So that's over here. But $4,000 here and $3,256 here don't balance. we need to reduce our bond premium. So to do that, we debited $744 to represent the full $4,000 in cash that will be paid out. Now, because we have debited to the bond premium, this is going to reduce the carrying amount of the bonds by the amount of premium that was amortized for that period. We continue to move forward with that, and then we would have an interest expense of $32.34 here. We would have premium amortized of $766 here. And then, of course, every time we pay, it will be $4,000. Now, that's in the world that's perfect. We issue and everything's based on perfect years. Uh, but sometimes that doesn't happen. So, if, for example, they need to prepare their financial statements at the end of February 2017 because they're not running on a calendar year, then the company is going to prorate the premium by the appropriate amount of the months to arrive at the proper interest expense. Now, what you'll notice here is that it's just the time proration, which is going to, in effect, be a straight line proration. So when we're looking at those fractional times within an interest period, uh, we don't go so far as to try to figure it out. Specifically, we use just the straight line method. To record that fractional interest period, then we would have 2/6 of the 4,000, and then we have 2/6 of the 744 for that period. And we would enter that 1,085.33, which is the difference, as our interest expense. And then we would have the premium on bonds payable for 248 and the interest payable representing the amount of full interest that we'll need to leave for 2 months at $1,333.33. We report bond discounts and premiums as either a direct deduction or addition to the face amount of the bond um, on the in the financial statements. So the discount and premium represent the difference between the face value and the cash proceeds that were received at issuance. Discounts are going to indicate that the amount of cash received or borrowed is less than the maturity obligation. This initial reduction from the proceeds results in an additional cost of borrowing. So it's an increase in our interest on bonds payable from the stated or the nominal amount. Discounts are a liability valuation account. Bonds payable is a liability. Discounts are attached to it. Um, as presented at any given point in time, it is going to reduce the total bonds payable liability. Um, it's going to have a debit balance, therefore, it is a contra account. However, flip side is when we issue at a premium, so we receive more in proceeds than the maturity valuation. Uh, we use the premium on bonds payable account, which is also a valuation account, to represent the excess of cash proceeds to maturity obligation. It increases the reported representation of the debt for any given point in time. So we will have that as also a credit on our financial statements. It is what is called an adjunct account because it is going to add to the account that it is attached to. So we will move on in the next one and talk about accounting for the extinguishment of debt. However, we'll end this specific uh, lecture right here because effective interest rate method, although it seems complicated because we are engaging in uh, something other than straight line, it's not going to be the same amount each time. It is presenting the most accurate picture of how the interest expense is actually occurring based on either the amount of interest that was in essence prepaid by not receiving the full face value of the bond issue, or the amount of interest obligation you will not have for those specific interest payments based on the excess in proceeds over face value at bond issue.